Hello, Dean Gilbert here from Mortgage Network again. I'd like to talk to you today about the 4 major loan programs. First, we have conventional, next FHA, VA, and USDA RD. Let's start with conventional, which is your primary conventional mortgage. It's your vanilla secondary market Fannie and Freddie mortgage. Has a 3% or 5% minimum down payment. Most people typically do 5% on this program. There's options for monthly PMI, lender paid PMI, and also single premium PMI. So there's many different options for choosing the type of mortgage insurance if you have less than 20% down. There's a $417,000 loan amount. In the state of Maine, we don't have anything over $417,000 unless you get into a jumbo mortgage. And it does allow for a non-occupant co-borrower. So if you have a mother or a father that would help you co-sign on the mortgage, if your income wasn't quite high enough to qualify, it is allowed for this program. Next, we'll move on to FHA. FHA is the Federal Housing Administration, and they allow a 3.5% down minimum monthly payment. This is fantastic because it allows you not only to purchase a single-family home, but also a multi-unit. It allows for lower credit scores. Right now, we can go as low as 580. It also allows for higher debt-to-income ratios, which is fantastic as well because it allows someone that may not have great income qualify to up to about a 50% debt-to-income ratio. There are loan limits with FHA. These loan limits are determined upon the county that you're in. So if you check the HUD's website, you'll be able to find that. In Cumberland County right now, it's $302,450, so $302,000 at $450. That's the loan limit. It has FHA monthly mortgage insurance as well as an upfront mortgage insurance. So that's one downfall with the FHA. You have to pay an upfront fee, that's 1.75% of your loan amount, as well as a monthly fee. And that can be as much as $800 or $850 for each $1,000 borrowed. And it does allow for a non-occupant co-borrower for single-family residences only. Next, VA, Veterans Administration. 100% financing available for qualified veterans. So what we would need to do if you're a qualified veteran would get your DD-214 to get a copy of your certificate of eligibility from the VA. Once we have that, we can determine if you're eligible or not. It allows for lower credit scores similar to FHA, and there's no monthly mortgage insurance. That is one of the best parts of VA, no monthly mortgage insurance. It does have a VA funding fee, which is determined based upon if it's your first time using VA or if you're a subsequent use VA. Finally, there's USDA Rural Development. No, this is not USDA steaks or chicken. This is a mortgage. 100% financing is available. Single family housing only. It does allow for somewhat lower credit scores. It has an income limit. So there's no loan amount limits, there's an income limit. That income limit is determined on the county that you live in. And it's also based upon the number of people in your household. For example, once you get up to 5 and 6 people in the household, the income limits get higher. The annual fee is similar to FHA, and it has a guaranteed fee. So the annual fee is like the monthly mortgage insurance. They call it an annual fee, but what it is, it's divided by 12 and made 1/12 of your payment. The guaranteed fee is financed in, similar to FHA. So this adds to your loan amount. So technically, if you're buying a $200,000 property and you're financing that fee, and your loan will be over $200,000. It does not allow for a non-occupied co-borrower. So that's the one downfall with the USDA is it doesn't allow for that non-occupant co-borrower. So to summarize, 4 main programs, pretty experienced in all of them. So if you have any questions, let me know. I'd be happy to figure out what the best fit is for you. Thanks and have a great day.